The stock market is a critical part of the financial system where investors buy and sell shares in publicly traded companies. It functions as a marketplace for these shares, which represent ownership in these companies. The stock market facilitates the exchange of capital between businesses and investors, enabling businesses to raise funds for expansion and operations, while offering investors the opportunity to grow their wealth through capital appreciation and dividends. At its core, the stock market works based on the principles of supply and demand. The prices of stocks fluctuate depending on how many people want to buy or sell a particular stock. If demand is high and more people want to buy a stock than sell it, the price rises. If the demand drops and more people want to sell, the price falls. This fluctuation is influenced by a variety of factors, including the company's performance, market trends, economic conditions, and investor sentiment. Stock exchanges like the New York Stock Exchange (NYSE) and Nasdaq provide the platforms where stocks are bought and sold. Companies list their shares on these exchanges through an initial public offering (IPO), where investors can purchase shares for the first time. Once the shares are listed, they can be traded by investors, who place orders to buy or sell stocks through brokers. The brokers are intermediaries who execute the trades for a commission or fee. When you buy stock, you become a partial owner of that company. This means that if the company performs well, the value of your shares may increase, and you might receive dividends. Dividends are periodic payments made to shareholders out of the company's profits, and not all companies pay dividends. Additionally, stock ownership comes with voting rights, allowing shareholders to vote on important decisions at annual meetings. There are different types of stocks in the market. The most common are common stocks and preferred stocks. Common stocks provide ownership in a company and typically come with voting rights. Preferred stocks, on the other hand, do not offer voting rights, but come with a fixed dividend, and preferred shareholders have priority over common shareholders in the event of liquidation. In addition to buying individual stocks, investors can diversify their portfolios through mutual funds and exchange-traded funds (ETFs). Mutual funds pool money from multiple investors to purchase a diversified portfolio of assets, while ETFs are investment funds that hold a variety of assets and trade on stock exchanges like individual stocks. Both mutual funds and ETFs help investors manage risk by providing exposure to multiple companies or sectors, which can reduce the impact of poor performance in any single asset. Investors use various strategies to navigate the stock market. One common strategy is the buy and hold approach, where investors purchase stocks with the intention of holding them for the long term. This strategy assumes that, despite short-term volatility, the stock market will generally increase in value over time. Another strategy is value investing, where investors seek stocks that are undervalued compared to their intrinsic worth. This strategy is commonly associated with Warren Buffett, who looks for companies with strong fundamentals that are trading for less than their true value. Growth investing is another popular strategy, which focuses on companies with high growth potential. Growth investors are willing to pay higher prices for stocks of companies that are expected to expand rapidly. While these stocks may be priced higher based on their potential, the goal is that their future growth will justify the investment. Conversely, income investing focuses on purchasing stocks that pay dividends, providing a steady stream of income. Dividend-paying stocks are particularly attractive to investors who want regular income, such as retirees. To make informed decisions, investors often perform analysis to evaluate stocks. There are two primary methods of stock analysis: technical analysis and fundamental analysis. Technical analysis involves studying historical price movements and trading volumes to predict future price trends. Technical analysts use charts and patterns to identify buying and selling opportunities. Fundamental analysis, on the other hand, looks at a company's financial health, earnings, management, industry position, and future growth prospects to determine the intrinsic value of its stock. Fundamental analysis focuses on long-term value, while technical analysis is often used for short-term trading. The stock market can be volatile, meaning that stock prices can experience significant fluctuations within short periods. This volatility is influenced by a wide range of factors, such as economic data, corporate earnings, political events, and global news. For example, when a company reports strong earnings, its stock price is likely to rise, while poor earnings can lead to a decline in its stock price. Similarly, macroeconomic factors like interest rates, inflation, and unemployment rates can influence investor sentiment and impact stock prices. Interest rates, for example, are a key factor in the stock market. When interest rates rise, borrowing costs increase, which can reduce consumer spending and business investment. This can negatively impact company earnings and consequently, stock prices. Conversely, when interest rates fall, borrowing becomes cheaper, which can stimulate spending and investment, leading to higher stock prices. Inflation is another important economic indicator that affects the stock market. High inflation can erode purchasing power, increase production costs, and squeeze company profits, which can result in lower stock prices. Geopolitical events, such as wars, natural disasters, or political instability, can also cause volatility in the stock market. For example, if a country faces political unrest, foreign investors may pull their money out of the country's stock market, leading to a decline in stock prices. Similarly, natural disasters, like hurricanes or earthquakes, can disrupt supply chains and negatively affect the performance of companies, leading to drops in stock prices. While the stock market is influenced by many external factors, investor sentiment plays a significant role in driving market movements. Investor sentiment refers to the overall mood or attitude of investors, which can be positive or negative. When investors feel confident about the economy and the stock market, they are more likely to buy stocks, driving prices up. However, when investors are fearful or uncertain about the future, they may sell stocks, causing prices to fall. Investor sentiment can be influenced by news reports, rumors, and social media, which is why it can sometimes lead to irrational behavior, such as panic selling or exuberant buying. Diversification is one of the most important principles in investing. It involves spreading your investments across different types of assets, such as stocks, bonds, and real estate, to reduce the risk of a significant loss. Diversification helps protect your portfolio from the negative impact of a single underperforming asset. For example, if one stock in your portfolio performs poorly, other stocks or assets may still perform well and help offset the loss. Diversifying your investments across various sectors, industries, and geographic regions can also help reduce risk and improve your chances of achieving long-term growth. Another important aspect of investing is risk management. The stock market involves inherent risks, and it's essential to have a strategy in place to manage those risks. One way to manage risk is through asset allocation, which refers to the distribution of your investments across different asset classes, such as stocks, bonds, and cash. By adjusting your asset allocation based on your risk tolerance, financial goals, and time horizon, you can help minimize the impact of market fluctuations. Risk management also involves setting realistic expectations and being prepared for market downturns. While the stock market has historically provided strong returns, over the long term, there will be periods of volatility and market declines. It's essential to stay focused on your long-term goals and avoid making emotional decisions based on short-term market movements. Market timing, or attempting to predict the best time to buy or sell stocks, is a challenging and often unsuccessful strategy. Many investors try to time the market by buying stocks when prices are low and selling when prices are high, but this approach is difficult to execute consistently. Even experienced investors struggle to time the market accurately, as stock prices can be influenced by unpredictable events. Instead of trying to time the market, many successful investors focus on long-term strategies and let their investments grow over time. Another important concept in investing is compounding. Compounding refers to the process of earning returns on your initial investment, as well as on the returns that accumulate over time. For example, if you invest $1,000 and earn a 5% return, your investment will grow to $1,050 after 1 year. If you reinvest that $1,050 and earn another 5% return in the following year, your investment will grow to $1,102.5. Compounding allows your wealth to grow exponentially over time, which is why starting early and staying invested for the long term is so important. The rise of online trading platforms has made it easier for individual investors to access the stock market and execute trades on their own. These platforms often offer lower fees than traditional brokers and provide tools and resources to help investors make informed decisions. While online trading has democratized investing, it also requires investors to take responsibility for their own research and decision-making. For beginners, it's essential to learn the basics of stock investing, including how to analyze stocks, manage risk, and develop a strategy. Investing in the stock market is not a get-rich-quick endeavor. While there are opportunities for significant gains, there are also risks involved. It's important to approach investing with a long-term mindset, focus on building a diversified portfolio, and be patient during periods of market volatility. With time, education, and discipline, investors can navigate the stock market and achieve their financial goals. In conclusion, the stock market is an essential component of the global economy, offering opportunities for both companies and investors. It requires knowledge, patience, and a long-term perspective. If you found this information helpful, don't forget to subscribe for more insightful content. Stay tuned for more tips on investing and financial markets.